Hi, my name's Tracy Burke.
And I'm Catherine Easels.
And welcome to Conrad Siegel's third quarter market update.
Together, we'll take a look at the investment market, what it did during the last quarter, what we can expect moving forward, and what it all means to you. We'll get started by looking back at what happened in the markets during the second quarter. Most areas of the stock market finished the first half with strong gains. This was likely due to optimism surrounding the economic recovery and strong corporate earnings. The S&P 500 is up over 15% year to date through June 30th, while small caps in the US did even better at about 17.5%. Value style stocks outpaced growth stocks during the first half of the year, and international stocks contributed to portfolio growth as well.
In the bond markets, after yields in the first quarter nearly doubled, the second quarter saw more volatility. The benchmark 10-year US Treasury yield finished the quarter at 1.45%. While higher yields are better for investors because of the inverse relationship with bond prices, the total return can be affected in times of interest rate volatility. While performance was better in the second quarter, the Bloomberg Barclays US Aggregate Bond Index is still down 1.6% year to date. Even though bonds have been underperforming stocks this year, they remain a critical part of a well-balanced portfolio and will help to taper losses when stocks do struggle.
Now, in terms of what's currently driving the markets, we're going to focus on two items. As Tracy mentioned, Treasury yields have been on a roller coaster this year. There are probably many reasons why yields have been declining in recent months. In the first quarter, longer-term yields spiked as investors eyed the reopening of the US economy as COVID restrictions were lifted. The 10-year Treasury yields, shown here, is used as a proxy for growth and inflation expectations 10 years down the road. Did investors push yields up too far and too fast? There seems to be retractment going on right now, along with the concerns of the Delta variant of COVID-19. The equity markets have also been on fire in the past 12 months with a robust recovery from the early days of the pandemic. However, concerns about peak growth and the Delta variant are currently haunting equity markets as well.
The other area we want to take a closer look at is inflation. The CPI, or Consumer Price Index, rose 5.4% at the end of June compared to the previous 12 months. The buzzword with inflation has been transitory, meaning that it's only temporary, not something that will likely impact us for years to come. Take the travel industry, for example. We saw prices plummet early in the pandemic, but these have been aggressively rebounding in recent months. If we focus on hotels and airfares, both are still below where they were 2 years ago, but are getting closer to pre-pandemic levels. The other reason inflation may be transitory is because of rising prices related to supply chain problems. Businesses that either closed or reduced production during the pandemic have been struggling to catch up with demand. Vehicles are an example of this. New car prices have increased recently due to the lack of supply and greater demand. These higher prices have driven consumers to consider used cars, driving up those prices dramatically, over 40% higher than 2 years ago. The hope is that once again supply catches up with demand, these prices will revert to pre-pandemic levels.
For our stat of the quarter, we're going to take a look at longer-term inflation trends. You can see that over the long term, inflation has jumped all over the place. Some of you may remember the sky-high inflation in the 1970s and the early 80s. While it has spiked recently to the highest level since 2008, it may indeed be more temporary in nature. You'll also notice that it's common that inflation often drops during recessions and then often rebounds after, not a surprising trend.
So what does all this mean? Should we be concerned about inflation and bond yields? We believe investors should focus on what we can control and not the outside noise. We want to focus on the long term and have portfolios that are well diversified, not making knee-jerk reactions to something that may or may not happen.
All good points, and that's so true. It's so easy to get caught up in all the noise out there. So I think that's going to about do it for this quarter's market update. If you have any questions on anything that you've heard today, please feel free to reach out to us.
And from all of us at Conrad Siegel, thanks for joining us today.
Until next time, stay safe, stay well, and stay invested.